As the debate over raising individual taxes heats up in Washington, there seems to be bipartisan agreement in at least one area. The U.S. corporate tax code is in need of an overhaul. A new study released today by PricewaterhouseCoopers shows that U.S. companies face the sixth highest effective tax rate in the world. The U.S. is also the only G7 country that taxes overseas earnings when brought back home. Joining us now is Johanna Schneider, Executive Director of External Relations at the Business Roundtable. It commissioned the study released today, and she joins us from our Washington bureau. Ms. Schneider, welcome to Bloomberg's Bottom Line. Thanks for coming on today.
Happy to be here.
Ms. Schneider, what companies were included in this study?
We looked at over 2,000 companies. They're on the Global 2000 list, the Forbes Global 2000 list, in 59 different countries. So it was a very extensive study.
What are the CEOs telling you?
Certainly. What CEOs, particularly our CEOs, are telling us is they do business around the world. And the U.S. tax system was once a leader in terms of allowing U.S. companies to be competitive. We overhauled our tax code in 1986, and yet there's been almost no changes to it since then. The rest of the world, however, has decided in order for their countries to be competitive, they have lowered their tax rates. So you see, we are now the second highest statutory tax rate, and most other countries are headed in the opposite direction. Germany, Canada, Japan, they're all lowering their corporate taxes.
Well, do the CEOs want to see a moratorium on these taxes, or do they want to see it eliminated outright?
Most of our CEOs would actually like the U.S. government to say, how can we build the most competitive tax rate in the world for the United States? So rather than making tiny, small, incremental changes, what they said is, let's overhaul the entire code. Let's take a look at it internationally and see how can we make the changes that will allow our U.S. companies to be the best and most competitive in the world. For most of our U.S. CEOs, that would mean lowering the corporate tax rate and changing to something called the territorial system. What that means is you wouldn't be taxed twice on earnings from abroad.
Well, as I'm sure you know, so many of the countries with low effective tax rates also have that value-added tax to help fund their government. The U.S. obviously doesn't. Is it fair to make that comparison then?
Well, it is an element of almost all the other countries who have lower effective rates than we do. So I think you're going to have to look at it overall in terms of corporate tax reform. You're at least going to have to compare apples to apples. The U.S. does not have it. It is not something that is being discussed right now, but it is something in all of the other countries. So you have to ask yourself, what role does that VAT tax play in their lower effective rate? Well, of course, it's a complicated series of equations, but we do need to look at it.
Well, as you know, there are some countries, especially those with the lowest effective tax rates like Hungary, they have only one or two represented companies in that study. Does that skew the results at all?
Well, and that's a very good question. I think when you look at the study, you'll see countries that most Americans would say are competitors. So you're looking at Germany, France, the UK, Canada. All of those countries have lower effective rates than ours, except for Germany, which has essentially the same effective rate. So the countries that you would expect that have large numbers of companies in their countries, they actually have a lower rate than ours. As you said, tiny, small companies that just have a couple of companies. We wanted to show them in the study, but you probably don't want to compare them directly.
Ms. Schneider, in our last minute, the CEO of GE, Jeff Immelt, he's the chairman of the President's Council on Jobs. He's also a member of the Business Roundtable. As you know, GE has been in the news, at least in the last couple of weeks, because of reports that the effective tax rate it paid from 2007 and 2009 was just about 7%. Is there going to be support for lowering the tax rate when some companies like GE already pay little or no taxes?
Well, there's a couple of things to remember on that note. 2009 was a very difficult year for both individuals and companies. We were just coming off of a very difficult recession in 08 and 09. So those tax rates, many of our companies lost money. So those tax rates would not be analogous to what we would expect in 2011 and 2012. And it's just like an individual. Different companies are like individuals. They have different deductions. So I think we'd like to see overall reform, including all the issues.
All right, Johanna Schneider. She is the Executive Director of External Relations
Thank you, Mark.
at the Business Roundtable. Thank you so much.